Yes.
Yeah.
Is there anything that anyone can do to help them through that? Because it really reduces their income.
Yeah, I think maybe if they move to another state.
Okay, well,
Well,
we want to keep our
no, we want to keep them
Michiganders
here.
here.
Yeah.
That's right.
Yeah.
Okay. What
And
about saving on inheritance taxes? How
Okay.
can we
Yeah,
work
well,
through that?
here's the good news.
Okay.
Okay, when you receive assets, when there's an estate, someone dies and there's an estate, there's two kinds of taxes that we have to look at. The first one is the federal estate tax, and the government last year moved that to $5.25 million. So there's no federal estate tax if the estate's under $5.25 million. And if it's a married couple, they get double that. They get $10.5 million. And it goes up by inflation every year. So less than 1% of our people in this country have to worry about federal estate taxes. And so don't worry about federal estate taxes unless you're over $10 million.
Okay.
Now, inheritance tax. Michigan has done away with its inheritance tax like 20 years ago. So we don't have an inheritance tax in the state of Michigan where you have to pay a certain percentage of whatever you inherit to the state. If the estate goes through the probate court, they value the assets and the estate has to pay an inventory fee. But if the assets don't go through probate, if they pass because they're in a trust or because there's beneficiaries, then the state of Michigan doesn't collect anything on it. So the good news is there's no inheritance tax. But where people do have to pay taxes when they inherit something is that the asset that they're receiving may have some unpaid taxes on it. And so then the person receiving it is going to have to pay income tax on that. And the most common one, it would be a retirement account like an IRA or a 401k. If you inherit an IRA or a 401k or 403b or 457 or any of those different numbered accounts, if you inherit those, that money in there has never had any taxes paid on it. The contribution that went in was deducted from your income tax, and all the growth grew and you didn't pay income tax on it. So if you inherit a $100,000 retirement account, you're going to have to pay tax on $100,000. And it goes on your tax return that year and gets added to your other income that you might have if you're working, your other earned income, if you're retired, your Social Security and your pension, and then you have to pay tax on the whole bundle. And so if it's a large IRA, it can push you right into that 39.6% bracket. But there is a way around that.
Okay.
It's called a stretch IRA. And so what you do is rather than take the $100,000, is you inform the custodian, the one holding the money, you know, like maybe it's in Fidelity or maybe it's in Merrill Lynch or maybe it's with an insurance company or maybe it's with a bank. But you tell the custodian, I don't want all the money at once. I want you to set this up as an inherited IRA and I want to stretch this out. And so then your only requirement is that you take a small amount out each year based upon your age. It's a required minimum distribution. There's an IRS schedule that tells you what the minimum is. You can take more if you want, but then you only have to pay tax on what you take out. Now, some people get confused because they'll say, well, no, required minimum distributions don't start till I'm 70 and a half. That's true if it's your IRA, but if you inherit an IRA, you have to take a required minimum distribution even if you were 20 years old.
Okay.
Or 30 or 40, but based upon the schedule, you might only have to take out 1 or 2%. Eat more if you want, but then it'll continue to grow, and so then maybe when you turn 62 or 66 and you want to retire, then there'll be more money in it when you started, and then you can use that in your retirement because you won't have any other income.
Right.
But you only have to pay tax on what you take out. But this is really important. Don't take the money out. I had one client come to me and say, I took the money, it's in my bank account, it hasn't been 60 days, and so let's roll it over into an inherited IRA. I'm sorry, I can't do that. The 60-day rule doesn't apply to inherited IRAs. You know, the 60-day rollover rule, that's for a person, that's for personal. But when you inherit an IRA, you can't take the money out. I had another one where they got the check. They hadn't cashed the check.
Yes.
They came to see me and said, here's my dad's IRA. Let's put this into inherited IRA. I said, no, I can't do that. We're going to call the company. We're going to give them the check back. Have them cancel it. They refused. So you can't take the money out of the account. You have to set that account up as an inherited IRA and then do the stretch. Now, later you can move that account custodian to somebody else if you don't like that custodian. But don't take the money out of the account, because if you do, you have to pay tax on the whole thing.
Now, would they contact you and say, okay, you're the person who is inheriting this, or will they just, if you inherit it, just cut you a check and send you the money? Will they contact you?
Well, first of all, they won't know that someone died until they're notified that someone died.
Right.
And then there are beneficiaries. They'll wait a while for the beneficiaries, or they'll try to contact the beneficiaries. But if your question is, will they warn you, don't take the money out?
Yeah, do they tell you that?
Some will, some won't.
Okay.
Yeah, this
need
is
to
something
know
you need to
that.
know.
Okay.
You heard it here.
Good. All right. Okay, then that is good to know.
Yeah.
Okay.
That will save you a lot in income taxes, because if you certainly don't want to pay 39.6% on an inheritance plus the Michigan 4 point something whatever to the government, and then what you have left is so then you're going to start investing that for your retirement.
Exactly.
Yeah.
And then you would be taxed on that depending on what your own income might
Right.
be and
Yep.
where that puts you in the tax bracket.
Right.
Okay.
Now, quickly, let me add, there's another strategy about income taxes, okay?
Mm-hmm.
The 15% tax bracket is pretty low. I mean, none of us like paying taxes, but 15% tax bracket is pretty low. And for a couple, they can earn up to around $75,000, okay? And so this is a totally different strategy. This one says, if you've got an IRA, you might want to take more out of your IRA and pay that 15% tax on it, because when your kids inherit it, they're not going to be in a 15% tax bracket. They're going to be in a much higher bracket.
Right.
And so if you know that my income is 50 and I could pull another 25,000 out and only pay 15% on it, that might make sense over not doing it, dying, having it go to your children, and they're going to pay in the 33 or 36% tax bracket if they're working.
Right.
So something that doesn't work for everybody, but this is a totally different strategy, not reducing taxes, but saying maybe it makes sense to intentionally pay some more taxes because I'm going to be in a lower bracket. Because no one thinks that 15% tax bracket is going to be around very much longer.
What are they thinking?
That our taxes are going to go up.
Right.
Because if you look at our deficit and our debts, and our taxes are everyone in the financial industry thinks our taxes are going up after the next election.
Okay, so I think we need to have a little finance class at the center, not just our elder law. Okay, let's go. So is there anything else regarding saving on inheritance tax?
Well, with the inheritance tax, I mean, we don't have an inheritance tax.
Right.
Right. And so another strategy is with your IRAs, and I have clients that they're going to be turning 70. Mm-hmm. Their pension and or their Social Security check is enough for them to live on, but they're going to be forced to take money out of their IRA in the future.
Right.
Because they're going to turn 70 and a half. And they'll say, when I turn 70 and a half, I'm going to have to take out $5,000, $10,000. I had one client, $90,000. Mm-hmm. What am I going to do with that?
Right.
What do I do with it? And so one of the strategies for that is, assuming that they're healthy, is life insurance. They could use that